As a low risk taker, is it every stock that you can invest in? Absolutely not. The last video I made, I spoke about some stocks that you can invest in as a low risk taker, because people usually scare low risk takers away from the stock markets, believing that since they cannot take risk, they should not come to the stock markets to invest at all. In the last video, I explained some of the stocks that you can buy as a low risk taker. A low risk taker simply means you are a conservative risk taker. You don't like taking risk. For instance, if you invest 1 million naira in any stock, you don't want anything to happen to that 1 million naira. You can't see your 1 million naira having a drawdown to 800,000 naira, which means 200,000 naira is gone out of your money. That is a low risk taker. But for somebody who is still a moderate risk taker, which we usually call the medium risk taker, they can still bear it when they see their investment going down to 800,000 naira. But anything below 800,000 naira, they too cannot take it. While a high risk taker can see this 1 million naira go down to as 500,000 naira. He knows that as long as I've not sold that stock, I'm yet to lose. So they don't mind, and sometimes when they have done their technical analysis, they usually believe that it will rebound. So they wait for that rebound, and eventually, when it is now back in profits, at times it may take months, at times it may take years. And that's why, as a low risk taker, you need to be careful and know that some stocks are not for you. So don't just take stock recommendation randomly online. Don't say because you have heard that a low risk taker cannot invest in the stock markets and now you want to invest. You need to be selective and be careful. Now, for instance, early this month, I decided to invest in a sum of money into the stock market, and I invested in some stocks. So now, two of it, let me just cite an example of two of it. One is already in plus 700, why 700,000, while another one is in minus 200,000. For a low risk taker, they cannot bear this at all. They will prefer something like this. But these two stocks, they are already in this category of stocks that I want to talk about. Because it is not every time that you have something like this. And that's why we usually teach diversification. Don't concentrate on one industry. Don't concentrate all your funds in one company. No matter how promising that company is, don't put all your eggs in one basket. I know Andrew Carnegie said, put all your eggs in one basket, just make sure you guard it jealously. But when he gave that advice, Andrew Carnegie was one of the richest men in US. When he gave that advice, he was talking about business, not about investments. He was talking about business, that when you want to start a business, focus on one business, just make sure you concentrate and guard that business jealously, not investments. Because every investment has its up and down. I hope you understand me. So, if I did not diversify, just imagine if I had just put my money in this. Only God knows how much I will be in loss by now. But because I was able to diversify. So, even at that buy this stock, don't buy this stock. Let the concept of diversification, let it be ingrained in your mind as a low risk taker. Whether as a low risk taker, a high risk taker, or a medium risk taker, let that concept of diversification, let it be ingrained in your mind. Let's go into it now. So what's the first type of stocks? First type of stocks. I'm not going to be mentioning companies in specific. I'm just going to give you a category. So when you have a stock recommendation, you cannot process it yourself. Where does this stock belong? What are they selling? What are they into? What industry do they belong to? Because by mentioning companies, it means maybe I will be demarketing the stock of that company, so which I wouldn't want to be part of. Do you understand? So that's why I will not mention company. If it were to be something positive, I can talk about it. So let's go into it. Number one is cyclical stocks. What do we mean by cyclical stocks? They are stocks that are sensitive to the performance of the economy. They are so sensitive. When the economy is booming, they are also booming. The moment the economy is down, they are down. Very sensitive. They deal with luxurious goods, automobile, construction. Those are the things they are into. When the economy is booming, people have money to spend. There's money in the economy. the economy is performing well, so people can spend on those things. Now, the moment there is contraction in the economy, then something happens to their stock. Their revenue goes down, their cost of sales, they can't maintain their cost of sales because their revenue has now gone down, and yet some of them still need to maintain the same cost of sale, thereby reducing their profit margin, and eventually it will affect what the profit they are making. And when they are reporting their quarterly earnings, eventually customers, shareholders, investors tend to sell because they are not making profits, especially if it is now a dividend paying company that they are expecting dividend and they are not paying the dividend, they get out of it. So beware of cyclical stocks. Beware of it. Any company that is dealing with luxurious goods, construction, automobile industry, any company that is not dealing with the essentials. Essentials means our needs, the things we cannot do without, which is food, clothing, majorly, transportation, healthcare. Those are the basics. I hope you get me. So let's move ahead. So cyclical stocks, run away from it. Number 2 is stocks with high volatility. Stocks with high volatility. When I say high volatility, for instance, as good as banking stocks are, they are volatile. You know the reason? They are regulated. See what happened in June. A news came out. CBN came out with a news. Before you know it, those stocks were already down 30%, 20%. Why? Because of a news of a fundamental that just came out. And people started selling. I remember in our group, WhatsApp group, a woman came and just asked that question. Even me, I did not know that news. I did not know about the news that very morning because majorly I invest for long term. It's only a word that I invest for short term. I invest majorly for long term. See what happens to the banking sector. Eventually, they are back up now. They are back up. And I remember when I read the news, I just told the woman, I said, please don't panic. This news is temporary. It's temporary. But just imagine, many people sold off that day. It's only people who have weathered the market that will stay in the markets. So if you know you are a low risk taker, you cannot witness this, what we call volatility. By the time you read this book, Psychology of Money by Morgan Housel, I think chapter 6 spoke about the price of winning, which is be ready to pay the price of volatility. When we say volatility, the price goes up and down. It goes up and down. So once you are not ready to pay this price of volatility, then run away from some stocks. And as a low risk taker, you cannot pay this price because you can see your 1 million naira going down to as little as going down to 700,000 naira, going down to 800,000 naira. So stick with the stocks I mentioned in that video, which if you are yet to watch it, go and watch it. I just released it yesterday. I hope you understand. So let's move on. Insurance stocks as well. A major reason why I don't really like insurance personally is because of their unpredictability. They are not so predictable. There are news, there are economic events that drives the stock, that drive the performance of that industry. And even it is not the performance of the industry as a whole. That's why you see that it was Sunu Assurance that did well last year, gaining over 700%. Now, this is what has happened to Sunu Assurance. It's down. It's currently down. You can see that sovereign trust insurance started moving up, I think, last week or 2 weeks ago. So please don't get involved in, as it can go up, it can also throw you down. So just be careful. Since you are not ready to study those macroeconomic events that drives the insurance industry, just stick with some of the stocks I mentioned yesterday, like the defensive stocks. Now, the last but not the least, any company you do not understand, don't invest in it. They mention the name of that company and you don't even know anything about it. You try reading about it and you know nothing about it. Please don't get yourself involved. I remember I was looking at some company yesterday and I saw that because there's something we call free floats. And that's when you see people coming online saying that talk about liquidity. You only need first, if you want to know how liquid a company is, go and look at their free float. It's usually in their quarterly earnings. Their free float. For instance, you see a publicly limited liability company and it is privately owned by maybe the owner and some people. 90% is privately owned. It is only 10% that is in the public. How do you expect such a company to have liquidity? How do you expect such? But people will tell you, buy these stocks. They won't tell you about that one. I'm not against stock recommendation, please. You can take stock recommendation, but the onus lies on you. The responsibility lies on you as an active investor to do basic research. I made a video on it, how to research a company before you invest in it. What are the things to ask? What are the questions to ask before you invest in any company? I hope you understand me. So please don't jump into it because, for instance, you are only told when to enter, you don't know when to exit. That's another point. A stock recommendation comes, you don't know about the company, you jumped into it, but the person did not tell you the exit points. Maybe, okay, once you get 20%, once you get 10%, get out of it. And one thing people don't normally come online to tell you, they only tell you about this. They don't tell you about this. So every time they tell you about the stock that is performing well, the stock that made them money, they will not tell you the stock that is making them to lose money. I hope you understand. I hope you have learned something today. So avoid these stocks as a low risk taker. If you have any question, comments, or thoughts, drop it in the comment section below. And I want to use this opportunity to invite you to this webinar that you are seeing the flyer now. It's happening this Saturday. Kindly visit the website to register. So we meet in our next video. Stay blessed.